Welcome to my channel. I'm Scott, and in this video I'm going to talk about commercial real estate. The high-level definition for CRE is its property used for businesses or 5+ unit living spaces. The purpose of commercial real estate is for income generation, so you lease the properties to tenants. There are many types of commercial real estate properties. A popular one is office space. You may work in one. Hotels and resorts. Retail, if you go to Starbucks, that's a retail space. Multifamily, for example, apartment buildings. Industrial, for warehousing, manufacturing companies. And mixed use, combination retail and residential. So on the bottom floor, maybe a Domino's pizza, and the 2 floors above that are people living in them. There are 4 types of commercial real estate: Class A, Class B, Class C, and Class D. Class A is the nicest. It has the best aesthetics and amenities, maybe a doorman, the construction is newer, higher quality infrastructure, and it's a good location. Then you have Class B. It's a little older construction, maybe smaller in stature. The common area may not be that big, an average size, and the rents are average, not too high. Class C, the rents are lower, the amenities are very limited, the construction may be older, and the location may not be that great. Most people don't live in a Class D. It's an older building in need of renovation. It may have been sitting there for many years, deteriorating. And once you buy a property, you want to rent it out. You may use a single net lease. That means the tenant is responsible for rent and taxes. If you offer double net leases, the tenant pays their rent, taxes, and insurance. I think the most common is triple net. And I've always thought of the name TIM. No one's told me that. I just used that acronym because I was interviewing at a commercial real estate company. So I just thought of TIM if they asked me what triple net was. So I can easily say that's taxes, insurance, and maintenance. So if you have a triple net lease, the tenant may pay $5,000 for rent and $1,000 for the triple net portion. So they just cut you a check for $6,000. Most real estate management companies offer 2 types of leases: triple net and gross. Single and double are not that popular. Gross is only when the tenant pays rent. The landlord pays the TIM, the taxes, insurance, and maintenance. If you were leasing a property and you were paying on a gross lease, your rent would just be a lot higher. So it's not like you're getting free insurance, taxes, and maintenance. It's just built into your rent. A really common term in commercial real estate is NOI, net operating income. That's the gross income, the rent you receive from your tenants, minus operating expenses. And operating expenses may be payroll. I might have to maintain the property. Maybe the roof needs to be redone. NOI is calculated before income taxes and interest, the interest on the mortgage. That's not part of NOI. It's similar to EBITDA, earnings before interest, taxes, depreciation, and amortization. It's the best and most common metric to assess a commercial property. So let me give you an example on NOI, net operating income. We need to figure out a gross income minus our operating expenses. So our gross income, it's rental income. Say we have 10 tenants, they pay $10,000 each, $100,000 of rental income. And we also make additional revenue on our parking lot, $25,000, and we have a little laundry room, and we make a little money on that, $5,000. So total revenue, $130,000. Operating expenses, we have a management company, we pay them $5,000. They handle a lot of the operational things, like collecting the rents, depositing the money into a bank account. We have to pay property taxes, $25,000. We have to maintain the property, that's $15,000, $1,000 of insurance. Our NOI for the property is $130,000 of revenue minus $46,000 of OPEX, so it's $84,000. That's our NOI. If this is a small property, that could be for the whole year. If it's a bigger property, that could be our monthly NOI. It's hard to compare NOI because say someone has a hotel and their NOI is $5 million and you own a little apartment complex, your NOI is $84,000. So you can't say they're doing better because they have more money. You have to look at the cap rate, your return. Because if your NOI for the year is $84,000, but you pay $10 million for the property, your cap rate is awful. Your return on investment is terrible. But if your NOI for the year is $84,000 and you paid $100,000 for the property, your return is amazing. You have an amazing cap rate. Let me show you. Capitalization rate, or cap rate, is NOI over the value of the property. Cap rate is a really common term in commercial real estate. It's like the price multiples, the PE, price to sales, price to book. You can compare different properties by measuring their profitability. It kind of equalizes things. It's pretty much your ROI, return on investment. It's one of the few ways to compare properties. Because like in that hotel example, you can't just assume the hotel is doing better because the NOI is higher. It might be doing better. So let's just pretend we paid $1.4 million and our NOI for the year was $84K. Remember, $130,000 of revenue from rent, parking, and laundry minus our expenses, $84K. So our cap rate is our NOI over market value, or $84K over $1.4 million, a 6% cap rate. Another way to think about it, NOI over cap rate equals the fair price of the property. If you were looking at commercial real estate properties and the broker said you should be able to generate about $84,000 of NOI or $84,000 of profit from this property. So with that information, knowing you would have an $84,000 NOI and you wanted a 6% cap rate, you would do $84,000 over 6%, $1.4 million. And then you would next ask the broker, well, how much is a property being sold for? And if he said $1.4 million, then you would think to yourself, that's a fair price. If he said $2 million, then you would say that's a bit overvalued. And if he said $1 million, then you would think that's a really good value. We'll get into this a lot deeper. I'm just trying to give you the high level right now. Another popular term is cash on cash return. That's your annual pre-tax cash flow over the amount invested. Probably the most common term is IRR. That or cap rate are the two most common terms. IRR, internal rate of return. This estimates the interest you'll earn on each dollar invested in a rental property over its holding period. And we'll do the calculation later. And we'll get into this really deeply, like we will cap rate. It's the rate of growth that a property has the potential to generate. The calculation goes beyond NOI and purchase price to estimate the long-term yield. If you do obtain a property, you want to add value. That's how we make money. You want to take that property, make it look nicer, maybe charge higher rents. How do you do that? Landscaping. You can make the front lawn look really nice, add flowers, put a new roof on, maybe solar. You can improve each unit. Fresh paint makes a huge difference. New lights, appliances, etc. You can also add a security system or a doorman. That can add a lot of value. Another thing you could do is cut costs. Maybe change management companies. Maybe the management company is charging too much. After you do these things, you could raise rents or bill tenants differently. Instead of them paying just rent, have them pay utilities as well. Decreasing vacancy has a huge impact. How do you decrease vacancy? Market the property better. Find higher quality brokers. Remember this example earlier, $130,000 of revenue from rental income, parking, and laundry. And we had $46,000 of expenses. Let's raise our revenue and decrease our expenses. Let's pretend we cleaned up each unit. We repainted it, maybe put newer furniture in there. So we raised rents by $100 per month per unit. And let's say we reduced OpEx $250 per month. Maybe the old management company was doing things inefficiently. And let's just pretend it was 11 units, this building. $100 each month of extra rent times 11 units times 12 months. So for the whole year, it's $13,200 in additional revenue. The new management company is much more efficient. The old company had 4 employees. The new one only 2, and they get the whole job done. So they charge $250 less each month. So we reduce expenses by $3K. So our income went from $130K to $143,200. Our expenses went from $46K to $43K. Now our NOI went up to $100,200. Before all these improvements, it was $84,000. Now, if we want to sell the property at a 6% cap rate, we can just do the math. $100,200 over 6%, almost $1.7 million. And we paid $1.4 million for the property. We paid $84,000 over 6%. That's a $270,000 profit. If it only cost us $100,000 for these improvements, we made a $170,000 profit. Or we can just maintain the property, collect the rents each month, and manage it. Some real estate developers buy the property, fix it up, charge higher rents, then sell to someone else. And there's other real estate developers that keep the property and just run it year after year and collect that monthly coupon payment. I'll show you step by step how to calculate the IRR, internal rate of return. First, you need to understand NPV, net present value. And this is the calculation for NPV. It's the future value of money divided by 1 plus your discount rate raised to the number of years or number of time periods. And all of that equals the present value. And we're going to use a discount rate, also known as the WACC, weighted average cost of capital, of 20%. How much would I need to invest today to get $400 1 year from now? At a 20% return, if I invested $333 today, I would get $400 1 year from now. So the NPV of $400 in 1 year is $333. The calculation is 400 divided by 1.2, because we're doing a 20% discount rate, raised to the first power. What's the present value of $400 in 2 years? The further you go out, the lower the present value. $400 2 years from now is worth $278 today. The calculation is 400 divided by 1.2 raised to the second power, because it's 2 years out. 1.2 raised to the second power is 1.44. So another way to say it is 400 over 1.44 equals 278. $400 3 years out, present value back today is $231. 4 years out is $193. If somebody offered us a project, so if we were to invest $1,000 in a project today, and we would receive $400 in cash flow 1 year from now, $400 2 years from now, $400 3 years from now, and $400 4 years from now. So 4 payments, $400 a year over 4 years. Should we invest $1,000 into this project? The way to answer that is to find out the NPV of the project. So the NPV is negative $1,000, that's our cash outflow in time 0, plus $333, that's the value of the $400 in year 1, discounted back to today's dollars, plus $278, plus $231, plus $193. So the NPV of the project is $35. So you would accept the project. The rule is you would accept a project with a positive NPV. 20% is a high discount rate. What if it was 10%? That's even better. The lower the discount rate, the higher the NPV. What if it was a really risky project and it had a 30% discount rate? Then it has a negative NPV, negative 134. We would not take on the project. Now that we know what NPV is, we can calculate IRR. IRR is the discount rate that makes the NPV equal to 0. So this is identical to the NPV calculation, but we need to change the discount rate to calculate the IRR. Since the NPV is positive, that means we need to raise the discount rate to get it to negative. Let's raise it to 24%, negative $38. The goal is an NPV of 0, so that's too high. Let's lower it to 23%, still too high. Let's lower it to 22%, a little too high. Let's go down to 21.9%, almost there, 21.85%. There it is. The IRR is 21.85%. So now we know the discount rate to make the NPV equal to 0. I think this last part will bring it all together and make sense. I'll show you how to calculate the NPV in Excel. You type equals NPV, open parenthesis, choose your discount rate, comma, then choose the numbers you want to discount back to today. So the $400 for the next 4 years. So that's $1,035. That's obviously not our NPV. You have to add your investment, your initial investment, which is negative $1,000. So that's your NPV, $35. It was a lot easier than doing all that math earlier. Internal rate of return is even easier. Equals IRR, then just choose all the numbers. and you see it's 22%. If I bring decimal out, you'll see it's exactly my number earlier, 21.86%. So the rule is only accept projects with a positive NPV. This has a positive NPV. Or only accept projects with an IRR greater than a WACC, and that's the case. If one is true, both will be true. And if one is false, both will be false. So in this case, you would accept a project, the NPV is greater than 0, or you can look at the IRR, which is greater than the WACC, so you would accept it. But it's not like you're getting a great deal. It's barely a positive NPV. Let's just say there was an alternative project that looked identical to this, except in year 4, you wouldn't receive $400, you would get $800. Maybe you invested in a bond, year 1 you would get paid $400, year 2 $400, year 3 $400, and year 4 $800. Now let's see the numbers change. Your NPV goes up to 228, your IRR is 30%, much higher than 20%. So this is a clear acceptance. So I hope you learned something new in this video. Leave a like, comment, subscribe. Talk to you soon.